Capital structure and weighted average cost of capital for a firm. This is part 1. Following are the learning outcomes. After going through this presentation, students would be able to analyze the different sources of funding available for a firm, such as debt, equity, and hybrid, which is also called as preferred stock. Students will be able to compute the weighted average cost of capital using company's capital structure. And later on, they'll be able to compute the cost of funds, compute the value of debt, preferred shares, and equity as a proportion of the balance sheet, and determine the feasibility of new projects based on this capital structure of a company. So what's a new project? Well, we've seen that in net present value and internal rate of return computations, that anything that produces new cash flows that is a new business development activity for a firm is a new project. So anything that is associated with new cash flow creation is very important to be evaluated properly with respect to the existing capital structure. If that new project does not provide incremental benefits, then there's no point in adopting such a project, because net to net, for every new dollar value of capital added, the company will become less profitable per unit value. So we need to know how to determine that rate at which this net present value of a new project needs to be calculated. So far, we've been completely dismissive of that rate, or have been taking that rate for granted. But from now on, we'll have to think about that rate very seriously. So companies typically just don't have equity as a source of funds. They also have debt and hybrid routes. So total debt to asset ratio of companies, industrials in particular, according to Mergent Online, is about 25% only. So to raise new funds, companies need not necessarily use equity or issuance of shares. They might also use the route for bonds or bank loans or preferred stock. They can use a combination of all of these. So the advantage of debt is that it costs less, and it's linked with the cost of government bond, which is very cheap as compared to the cost of equity, as we're going to see now. Equity typically costs much more. For industrials for the period 2014 to 2018, it typically costed between 20 and 25%. So for every $100 borrowed through the equity route, through the issuance of shares, companies typically had to return between $20 and $25 per year for those $100. And that makes it very expensive, because debt typically costs a lot less, 10% and below. We'll see that in just a minute. And the risk is that there's a risk of equity, there's a risk of debt. So if we mix it up, then we are able to diversify or hedge away that risk by issuance of a mixed variety of debt and equity. So this is a chart, again, taken from Mergent Online, as is the next chart. Well, no, next chart is from another source, which tells us how much return on equity, or how much companies had to return to their shareholders per year. So it ranged between 17%, and in bad years it also went down to 13.5%, and went all the way up to 30% in 2021. So the conclusion is equity is very expensive to raise. And here is the cost of debt. Now, in fact, the cost of debt here we are considering is not even the premium quality debt. This is double B, which is slightly below the investment grade. And typically, as you go down in terms of investment grade, in terms of investability, the rate of borrowing increases. So in this case, for example, the cost of borrowing for these companies, the highest was at the peak of the pandemic, or the recession caused by the pandemic in 2020, at 9%. And currently, even after the hike in interest rates in 2023, the rate is still hovering between 6 and 8%. So even sub-investment quality grade bonds are being issued at 8 to 10%. And these typically, the instrument that's used here is the Intercontinental Exchange Bank of America BB bonds, which have a maturity between 3 to 10 years. And these are being raised between 6 and 8% YTM, yield to maturity. So comparing that 7 to 8% with 20 to 25% is just, it seems obvious that companies should raise at least a part of their new money for project funding through debt route. And that's the reason why we must study this chapter. So if we compare the debt to equity, in case 1, if we have just equity and pay 20%, that makes a lot of projects infeasible, particularly with respect to net present value, because the rate of discount is in the denominator. And that makes NPV very small. Case 2, if we just go through debt at a cheaper rate, let's say 8 to 9%, as we saw in the previous slide, it can make it very risky, particularly if a company is going through hard times. What they can do is, if it's just equity, they can cancel their dividends, and even if they become unprofitable, they don't owe any money to anyone in terms of interest or coupon payments. But if they've raised money through debt, then they have to repay that money. Otherwise, they have to file for Chapter 11 bankruptcy, which makes it very risky. So the flip side, to summarize, is company can suspend dividends, but they cannot stop paying coupon or interest or principal or face value payments for bondholders or lenders. So debt, that's why it's very risky. The third case is if you mix it up. The advantage is now we have some debt to pay, but we also have a cheaper cost of overall capital. And that is why this chapter is so important. Every company has some debt and some equity, depending on how much risk they perceive their business to have in terms of how much can they repay to the bondholders. That's why this chapter is so important. So in order to finance a debt, companies typically do bank borrowing, which is called term loan, and bond issuances. Each of them has a cost component, which we label in this particular discussion as RD, rate of return on debt, which is being returned to bond investors. Equity is achieved through selling of common stock, either through initial public offering or through secondary offerings. And it is also used by refunneling profits from previous year and it's called as internal funds. So instead of giving dividends, the company can plow back all the profits to use them for next year's operations. And in the early to mid 2000s, the companies such as Tesla, Amazon, and Netflix have successfully used this model to plow back their profits into equity or creation of new capital, because it's just their business is just such a high return producer. So the cost component of this return is RE, return on equity. And the third is preferred or hybrid stock. And the preferred stock cost component is labeled as R, or return PS preferred stock. Moving on. So the weighted average cost of capital, whose acronym is WACC, weighted average cost of capital. It's the weighted average of cost of debt, cost of equity, and hybrid or preferred shares costs. And the weights that are used are either the book value or the market value of the dollar amount of debt, equity, and preferred stock. And we'll see that now through an example. So let's look at KMZ Airlines. On the left-hand side is its assets, and on the right-hand side it is liabilities. So it has two types of assets, which we know, short-term and long-term. And then it has total debt in terms of liability. So the total asset size is $700. The total debt is 30% of $700, or $210. In fact, we can find out the other way around. What is the value, debt to value of total debt? It is 210 that divided by the total asset size, which is 700, or 30%. Similarly, shareholders' equity, it is a sum total of stock issued plus retained earnings of 490, and the component of shareholders' equity is not 210 but 490 divided by 700, or 70%. We'll do that in Excel in just a bit, and the two add up together to 100%. And let's assume the cost of debt to be 8%, meaning we pay 8% interest to our lenders, and we pay 22% return on equity to our shareholders. So what is the weighted average cost of capital? It'll be 8% times 30%, 8% cost times 30% component of debt, 22% cost times 70% component of equity, and that gives us 2.4 plus of 15.4 or 17.8%. So the weighted average cost of capital of KMZ Airlines with this structure is 17.8%. It's also called as the weighted average cost of capital. Right now, let's assume no taxes. So we're going to go. So now let's go to Excel. Going to Excel. So let's take the short-term assets as 200. Long-term assets as 500. And total assets is a sum of these two. Total debt, let's go back to our PowerPoint, 210 and 490. Total value, just copy paste, copy paste. And then first of all we have to find out the component. So by V, and so equals this divided by this, and equals this divided by this. So 30% and 70% respectively. And then the cost of debt is 8% and 22%. So 8% and 22%. And we know that we can use a sum product function. So equals sum product of this comma this divided by the total value. That'll give us 17.8%. Shift Control 5, Alt H 0 gives us one decimal place. So that's how we get the 17% weighted average cost of capital. Going back, so that's how we get the 17.8. Now, total value is defined as debt plus equity. The cost of capital, which is also the portfolio return for the company, is the contribution of the debt, which in our case was 30%, times the return on debt, plus the contribution of equity, which in our case was 70%, times the cost of equity, which was 22%. And that gives us that weighted average cost of capital. Now, there's another bonus for issuing debt, and that is savings and taxes. So let's see that really briefly. So let's assume we earn a profit before interest and taxes of $500. We pay an interest at 8%. Let's assume initially we don't have any debt on our balance sheet, so we don't pay any interest on it. So the interest is 0. The earnings before tax, therefore, is 500 minus 0 is 500 because there's no interest. And we pay a tax at 21%, which is the current corporate tax rate in the United States. So 21% of 500 is 105. $105 of tax is paid to the government. And then profit after tax that's left behind is 500 minus 105, or 395. So you can see the whole working of income, partial working of income statement. Now moving on, let's take on some debt. So let's take $100 of interest charge as debt. So we must have taken 100 divided by 0.08, or 10,000 divided by 8, or $1,250 as debt. So we pay $100 as interest. So earnings before tax is 500 minus 100, or 400. Now 21% of 400 is no longer 105. That's the benefit and beauty of taking on debt. So 21% of 400 is $84. And we remove 84 from 400, we end up with $316. So although what has happened is we have reduced our profit after tax by $79, our interest burden has not gone up by $79. It has gone up by much more than that, $100. So to pay $100 of interest, our profit only decreased by $79. So you can compare. Shareholders' profit is not exactly the same as bondholders' interest payments. We can pay much more in interest as compared to what we can pay to shareholders in profits. That is the conclusion. So therefore, that makes debt even more cheap by that 21%. So did we lose $100? Sure we did. But how much did we gain back? We gained $100 and we lost $79. And that's coming from that 316. And so we lost $79. Really, we didn't lose $100 in terms of bond payments. So the gain is that the way we calculate that $79 is 0.79 times 100. $100 was the interest payment, and 0.79 is 1 minus 21%, the tax rate right here. So let's do this calculation really quick. So going back to Excel, our earnings before interest and tax is 500. Our interest is 100. Our interest, well, let's just make it 0 first. So equals this minus this, this minus this, and then equals this times how much tax? 0.21, and then equals this minus this. So we've got the profit of 395. But as soon as we make this 100, so we have increased our interest burden to bondholders by $100. Our profit after tax only decreased by $79. That's the beauty of this calculation. So our interest burden has gone up, but our profit did not fall down by the same amount. And that's why bonds are really not as expensive as they seem. So the equivalent is this times parenthesis 1 minus 0.21, the tax rate, is the benefit of savings. So if we add this to this, we'll come back to 395, the old profit, which if I remove this here, look at that, 395. And if I keep it here, then, so my loss really is that $79, but my gain is $100. So I'm getting to pay a lower interest to the bondholders as compared to what I would have paid to stockholders. Coming back, so the cost on debt is defined as interest times 1 minus the tax rate. $79 is 100 times 1 minus 0.21. I would have paid $100 to my bondholders, but my equivalent payment to stockholders essentially is only $79. That's why I can pay a whole lot more to bondholders than stockholders. Therefore, it makes sense to borrow money from bonds because I can pay more to the bondholders. And so this is 100, the interest times 1 minus tax rate, 0.79 or $79. So therefore, our formula now gets adjusted with that tax rate adjustment. Cost of capital is a component of debt times return on debt times 1 minus tax rate plus component of equity times return on equity. And the last piece here is the preferred stock. So it acts like debt, that is, it has a face value per share, and therefore it has a dividend. But that dividend, because it has no maturity, kind of like common stock, is fixed. And therefore, I have to, as a company, I must pay the dividend before I pay dividends to ordinary shareholders. So the order of payments that a company has is pay the bondholders, then pay preferred stockholders, and then pay common stockholders. If I cannot pay preferred stockholders, that's a big problem. I don't have to file Chapter 11 bankruptcy as a company in that case, but then we have to accumulate those dividends over time and then pay them off later on. That is why preferred stock is a hybrid of debt and equity. And moreover, investors also have the option to convert preferred stock into equity, kind of like what Warren Buffett did with Bank of America shares in 2011. And so preferred stock also goes into the liability side of the balance sheet. So what does this do to us? This was our original formula, right? The debt part and the equity part. Now we have this. As soon as we bring in the preferred stock, we have the debt part, the preferred stock part. So this is the contribution of preferred stock divided by the total value times return on the preferred stock, and the contribution of equity to the total value times return on equity. And so therefore the total value is the value of debt plus value of preferred stock plus value of equity. To conclude, a firm has many options to raise capital and money to fuel or fund its long-term expansion plans. Debt is very selective. The more we borrow, the less lenders give us money, but it's cheaper and it has tax advantages. Then hybrid is generally preferred by companies when they're in distress. They don't like to issue hybrid stock too much, but it converts to equity, and it's slightly better than equity in terms of cost. Equity is the most expensive, and the weighted average cost of capital is the value of debt contribution of debt times 1 minus tax rate times the cost of debt plus the contribution of equity times the cost of equity plus the contribution of preferred stock times the cost of preferred stock. And that's part one. Thank you for listening.